Unlocking Growth, Strategies and Prospects of QQQY ETF. As investors strive to navigate the ever-changing landscape of financial markets, the QQQY ETF emerges as a beacon of opportunity, offering access to companies at the forefront of technological innovation and sectoral trends. In this comprehensive guide, we delve into the strategies employed by the QQQY ETF to capture long-term growth and deliver value to shareholders. Question 1. What is the overall investment objective of the QQQY ETF? The QQQY ETF, or the Invesco Nasdaq 100 Equal-Weighted ETF, is a prominent player in the ETF market, known for its unique investment approach and focus on equal-weighted exposure to the Nasdaq 100 index. With the rapid proliferation of ETFs offering various investment strategies, understanding the core investment objective of QQQY is essential for investors seeking exposure to this segment of the market. The overarching investment objective of the QQQY ETF is to provide investors with diversified exposure to the Nasdaq 100 index while employing an equal-weighted methodology. This objective is underpinned by several key principles and strategies that guide the fund's investment process. 1. Diversification. QQQY aims to offer investors a diversified portfolio by providing exposure to a broad range of companies listed on the Nasdaq 100 index. By investing in a basket of securities spanning multiple sectors, industries, and market capitalizations, the fund seeks to mitigate single-stock risk and enhance portfolio diversification. 2. Equal weighting. Unlike traditional market cap-weighted ETFs, which allocate higher weights to larger companies within the index, QQQY adopts an equal-weighted methodology. This means that each constituent stock in the Nasdaq 100 index receives an equal allocation within the ETF's portfolio. By equal-weighting its holdings, QQQY aims to avoid concentration risk and potentially capture opportunities among smaller or less recognized companies within the index. 3. Exposure to growth-oriented companies. The Nasdaq 100 index is renowned for its focus on technology and growth-oriented companies, making it an attractive investment universe for investors seeking exposure to innovative and high-growth sectors. QQQY leverages this characteristic by providing investors with access to a portfolio of companies at the forefront of technological innovation, including leading technology giants, healthcare innovators, and consumer discretionary companies. 4. Potential for outperformance. By adopting an equal-weighted methodology, QQQY has the potential to outperform traditional market cap-weighted ETFs, particularly during periods of heightened volatility or market dislocation. Equal-weighted strategies inherently rebalance the portfolio by selling winners and buying losers, which may enhance the fund's ability to capitalize on market inefficiencies and exploit opportunities for alpha generation. 5. Rebalancing. QQQY employs a systematic rebalancing process to ensure that the portfolio maintains its equal-weighted exposure to the underlying index over time. This disciplined approach involves periodically adjusting the weights of individual holdings to reflect changes in their market values relative to other constituents. Rebalancing allows the fund to stay true to its equal-weighted mandate and avoid drift from its target allocation. In conclusion, the QQQY ETF offers investors a unique opportunity to gain diversified exposure to the Nasdaq 100 index through an equal-weighted investment approach. With its focus on diversification, equal weighting, exposure to growth-oriented companies, potential for outperformance, and disciplined rebalancing process, QQQY aims to achieve its investment objective of delivering long-term capital appreciation to investors. By understanding the core principles and strategies underlying QQQY, investors can make informed decisions about incorporating this ETF into their investment portfolios, potentially enhancing their risk-adjusted returns and achieving their financial goals. Question 2. What is the rationale behind the selection of the underlying securities within the QQQY ETF? The QQQY ETF, or the Invesco Nasdaq 100 Equal-Weighted ETF, is renowned for its unique investment approach, providing investors with equal-weighted exposure to the Nasdaq 100 index. Central to the fund's success is the meticulous selection of underlying securities, which are instrumental in achieving diversification, mitigating risk, and capturing growth opportunities within the index. Rationale behind security selection. 1. Index representation. The selection of underlying securities within the QQQY ETF is primarily driven by the composition of the Nasdaq 100 index. As a benchmark index comprising the 100 largest non-financial companies listed on the Nasdaq stock market, the index serves as a comprehensive universe of high-growth, technology-driven companies. By replicating the constituents of the Nasdaq 100 index, QQQY ensures alignment with the index's sectoral and thematic exposures. 2. Equal weighting. A distinguishing feature of the QQQY ETF is its equal-weighted methodology, whereby each constituent stock receives an equal allocation within the portfolio. This approach contrasts with traditional market cap-weighted ETFs, which allocate higher weights to larger companies based on their market capitalizations. The rationale behind equal weighting is to avoid concentration risk and provide investors with more balanced exposure to individual securities within the index. 3. Sectoral diversification. QQQY seeks to achieve sectoral diversification by selecting underlying securities from a broad range of sectors represented in the Nasdaq 100 index. While the index is heavily weighted towards technology and communication services sectors, it also includes significant exposure to healthcare, consumer discretionary, and industrial sectors, among others. By diversifying across sectors, QQQY aims to mitigate sector-specific risks and capture opportunities for growth and innovation across various industries. 4. Growth orientation. The selection of underlying securities within the QQQY ETF is skewed towards companies exhibiting strong growth prospects, technological innovation, and disruptive business models. The Nasdaq 100 index is known for its focus on growth-oriented companies, including leading technology giants, biotechnology firms, and e-commerce platforms. QQQY capitalizes on this growth orientation by investing in companies poised to capitalize on emerging trends, such as cloud computing, artificial intelligence, and digital transformation. 5. Liquidity and trading volume. In selecting underlying securities, QQQY considers factors such as liquidity and trading volume to ensure efficient portfolio management and minimize transaction costs. Securities with higher liquidity and trading volume are favored, as they offer greater ease of trading and liquidity provision, especially during periods of market volatility or rebalancing. 6. Fundamental and technical analysis. QQQY employs a combination of fundamental and technical analysis to assess the attractiveness of individual securities within the index. Fundamental analysis involves evaluating factors such as earnings growth, revenue prospects, competitive positioning, and valuation metrics to identify high-quality companies with strong growth potential. Technical analysis, on the other hand, examines price trends, trading patterns, and market sentiment to gauge short-term momentum and entry/exit points for securities. In conclusion, the selection of underlying securities within the QQQY ETF is driven by a combination of factors, including index representation, equal weighting, sectoral diversification, growth orientation, liquidity considerations, and fundamental/technical analysis. By adhering to these principles, QQQY aims to construct a diversified portfolio of high-growth companies that mirrors the composition of the Nasdaq 100 index while offering potential for long-term capital appreciation. By understanding the rationale behind security selection, investors can gain confidence in the composition and strategy of the QQQY ETF, potentially enhancing their investment decisions and achieving their financial objectives. Question 3. How does the QQQY ETF manage its exposure to sector concentration risk, given the technology-heavy nature of the Nasdaq 100? The Nasdaq 100 index, dominated by technology and communication services companies, presents a unique set of challenges for investors seeking exposure to this high-growth segment of the market. Sector concentration risk, stemming from the overweighting of certain sectors within the index, can significantly impact portfolio performance and increase vulnerability to sector-specific shocks. As such, understanding how the QQQY ETF manages sector concentration risk is essential for investors evaluating its suitability within their portfolios. Managing sector concentration risk. 1. Equal weighting methodology. A cornerstone of the QQQY ETF's approach to managing sector concentration risk is its equal-weighted methodology. Unlike traditional market cap-weighted ETFs, which allocate higher weights to larger companies within the index, QQQY assigns equal weights to all constituent stocks. This approach ensures that no single sector dominates the portfolio, thereby reducing sector concentration risk and enhancing diversification. 2. Sectoral diversification. QQQY employs a disciplined sectoral diversification strategy to mitigate sector concentration risk while maintaining exposure to high-growth sectors represented in the Nasdaq 100 index. By allocating capital across multiple sectors, including technology, healthcare, consumer discretionary, and industrials, the ETF aims to spread risk and capture opportunities for growth across diverse industries. 3. Dynamic rebalancing. To address fluctuations in sectoral weights and maintain a balanced portfolio, QQQY implements a dynamic rebalancing process. This involves periodic adjustments to the weights of individual sectors to ensure adherence to the fund's equal-weighted mandate. During rebalancing, sectors that have experienced significant price appreciation are trimmed, while underperforming sectors are added to rebalance the portfolio back to its target allocation. 4. Risk monitoring and analysis. QQQY employs robust risk monitoring and analysis techniques to assess sector concentration risk and identify potential vulnerabilities within the portfolio. Through quantitative analysis of sectoral exposures, correlation matrices, and stress testing scenarios, the ETF's portfolio managers gain insights into the impact of sectoral movements on overall portfolio risk and performance. This proactive approach enables QQQY to adjust its sectoral allocations dynamically in response to changing market conditions and risk profiles. 5. Sector rotation strategies. In addition to equal weighting and dynamic rebalancing, QQQY may employ sector rotation strategies to actively manage sector concentration risk and capitalize on emerging trends or opportunities within the market. By systematically rotating capital across sectors based on relative strength, valuation metrics, and macroeconomic factors, the ETF seeks to optimize risk-adjusted returns and enhance portfolio diversification. 6. Enhanced indexing techniques. QQQY may utilize enhanced indexing techniques, such as factor-based investing or smart beta strategies, to further mitigate sector concentration risk and enhance portfolio efficiency. These techniques involve weighting securities based on specific factors, such as value, momentum, or quality, rather than market capitalization alone. By incorporating additional risk factors and diversification metrics into the investment process, QQQY aims to improve risk-adjusted returns and reduce reliance on sector-specific drivers. In conclusion, the QQQY ETF employs a multifaceted approach to managing sector concentration risk, leveraging equal weighting, sectoral diversification, dynamic rebalancing, risk monitoring, sector rotation strategies, and enhanced indexing techniques. By adopting these strategies, the ETF aims to mitigate the inherent sectoral imbalances within the Nasdaq 100 index while capturing opportunities for long-term growth across diverse industries. Investors seeking exposure to high-growth sectors can benefit from QQQY's ability to manage sector concentration risk effectively, potentially enhancing portfolio diversification and risk-adjusted returns. Question 4. How does the ETF strategy adapt to changing market conditions or economic cycles? The ability to adapt to changing market conditions and economic cycles is paramount for the success of any investment strategy. ETFs, as passive or actively managed investment vehicles, must possess flexibility and agility to capitalize on opportunities and mitigate risks amid market fluctuations. The QQQY ETF, known for its equal-weighted exposure to the Nasdaq 100 index, employs a dynamic strategy designed to adapt to evolving market dynamics while maintaining its investment objectives. Adapting to changing market conditions. 1. Tactical asset allocation. QQQY incorporates tactical asset allocation strategies to adjust its portfolio composition in response to changing market conditions. This may involve reallocating capital across asset classes, sectors, or regions based on macroeconomic indicators, market valuations, and risk factors. By dynamically adjusting asset allocation, the ETF seeks to optimize risk-adjusted returns and capitalize on prevailing market trends. 2. Sector rotation. Recognizing that different sectors perform differently at various stages of the economic cycle, QQQY may employ sector rotation strategies to capitalize on sector-specific opportunities. During economic expansions, the ETF may overweight sectors poised to benefit from growth, such as technology, consumer discretionary, and industrials. Conversely, during economic contractions, it may shift exposure towards defensive sectors, such as utilities, healthcare, and consumer staples, to mitigate downside risk. 3. Risk management. QQQY employs robust risk management techniques to identify, assess, and mitigate portfolio risks across different market environments. This includes monitoring factors such as volatility, correlation, liquidity, and concentration risk to ensure that the portfolio remains resilient under adverse conditions. By actively managing risk exposures and implementing hedging strategies, the ETF aims to protect capital and preserve long-term wealth. 4. Portfolio rebalancing. Regular portfolio rebalancing is a key component of QQQY's strategy to maintain alignment with its investment objectives and risk tolerance. Rebalancing involves periodically adjusting the weights of individual securities or asset classes to restore the portfolio's target allocation. This disciplined approach ensures that the ETF remains diversified and responsive to changes in market dynamics, reducing the potential for drift from its intended investment strategy. 5. Dynamic asset selection. QQQY may dynamically adjust its asset selection criteria based on prevailing market conditions, investor sentiment, and valuation metrics. This may involve tilting the portfolio towards undervalued or out-of-favor securities during market downturns, while reducing exposure to overvalued or overbought assets during market upswings. By systematically evaluating investment opportunities and adjusting asset selection criteria, the ETF aims to enhance risk-adjusted returns and capitalize on market inefficiencies. 6. Active engagement. In addition to passive index tracking, QQQY may engage in active management strategies, such as security selection, thematic investing, or opportunistic trading, to exploit short-term opportunities or mitigate risks. This may involve leveraging fundamental analysis, technical indicators, or proprietary models to identify mispriced securities, thematic trends, or market anomalies. Through active engagement, the ETF seeks to add value and enhance performance relative to its benchmark index, In conclusion, the QQQY ETF demonstrates a flexible and adaptive strategy designed to navigate changing market conditions and economic cycles effectively. Through tactical asset allocation, sector rotation, risk management, portfolio rebalancing, dynamic asset selection, and active engagement, the ETF aims to optimize risk-adjusted returns and deliver long-term value to investors. By understanding QQQY's approach to adapting to market dynamics, investors can gain confidence in its ability to withstand uncertainty and capitalize on opportunities across diverse market environments. Question 5. What is the dividend reinvestment strategy for the QQQY ETF? Dividend reinvestment is a fundamental component of many investors' wealth-building strategies, allowing them to harness the power of compounding to generate wealth over time. Within the realm of ETF investing, dividend reinvestment plays a crucial role in maximizing returns and capitalizing on the income-generating potential of underlying securities. The QQQY ETF, known for its equal-weighted exposure to the Nasdaq 100 index, implements a dividend reinvestment strategy aimed at enhancing long-term investor returns while maintaining alignment with its investment objectives. Understanding the dividend reinvestment strategy. 1. Dividend yield. The QQQY ETF invests in companies listed on the Nasdaq 100 index, many of which are known for their dividend-paying capabilities. The dividend yield of the ETF reflects the aggregate dividend payments received from its underlying holdings relative to its net asset value, NAV. By investing in dividend-paying companies, QQQY aims to generate a steady stream of income for investors while potentially enhancing total returns over time. 2. Distribution frequency. QQQY's dividend reinvestment strategy is influenced by the distribution frequency of its underlying securities. The Nasdaq 100 index constituents vary in their dividend payment schedules, with some companies paying dividends on a quarterly basis, while others pay semi-annually or annually. QQQY tracks these dividend distributions and reinvests them into the fund according to its established reinvestment schedule. 3. Reinvestment options. QQQY offers investors several options for dividend reinvestment, including automatic reinvestment programs, DRIPs, and manual reinvestment through brokerage accounts. DRIPs allow investors to automatically reinvest dividends into additional shares of the ETF, typically without incurring transaction fees. This enables investors to harness the power of compounding by reinvesting dividends back into the fund, potentially accelerating portfolio growth over time. 4. Tax implications. Dividend reinvestment may have tax implications for investors, depending on the type of account in which the QQQY ETF is held. In taxable brokerage accounts, reinvested dividends are typically subject to taxation, as they are considered taxable income. However, in tax-advantaged accounts such as IRAs or 401(k)s, dividends may be reinvested without immediate tax consequences, allowing for tax-deferred growth. 5. Performance impact. The dividend reinvestment strategy implemented by QQQY can have a significant impact on the fund's overall performance and total return. By reinvesting dividends back into the fund, investors benefit from compounding growth, potentially enhancing total returns over the long term. This can be particularly advantageous during periods of market volatility or when reinvested dividends are used to purchase shares at discounted prices. In conclusion, the dividend reinvestment strategy employed by the QQQY ETF is a powerful tool for enhancing long-term investor returns and compounding wealth. Through dividend yield, distribution frequency, reinvestment options, tax implications, and performance impact, investors can gain a comprehensive understanding of QQQY's approach to dividend reinvestment and its potential benefits for portfolio growth. By harnessing the power of compounding, Dividend reinvestment allows investors to maximize the wealth-building potential of the ETF while aligning with their long-term investment objectives. Question 6. What hedging strategies, if any, does the QQQY ETF employ to mitigate downside risk in volatile market conditions? Volatility in financial markets can expose investors to downside risk, jeopardizing investment returns and capital preservation. In response to these challenges, ETFs like QQQY implement hedging strategies to mitigate risk and safeguard investor assets. By employing a combination of protective measures, including option strategies, derivatives, inverse ETFs, and dynamic asset allocation, QQQY aims to navigate volatile market conditions while preserving long-term investor value. Exploring hedging strategies. 1. Option strategies. QQQY may utilize option strategies, such as purchasing put options or writing covered calls, to hedge against downside risk in volatile markets. Put options provide the right to sell underlying securities at a predetermined price within a specified time frame, offering downside protection in the event of market downturns. Conversely, covered calls involve selling call options on existing holdings, generating income while capping potential upside gains. By incorporating option strategies, QQQY aims to enhance risk-adjusted returns and mitigate losses during periods of market turbulence. 2. Derivatives. Derivative instruments, such as futures contracts or swaps, can be employed by QQQY to hedge against adverse market movements and mitigate downside risk. Futures contracts allow the ETF to hedge its exposure to underlying securities by locking in prices for future delivery, providing protection against adverse price movements. Swaps, on the other hand, enable QQQY to exchange cash flows with counterparties based on predefined terms, effectively hedging against specific risks, such as interest rate or currency fluctuations. By strategically utilizing derivatives, QQQY seeks to manage portfolio risk and enhance overall performance in volatile market conditions. 3. Inverse ETFs. Inverse ETFs, or short ETFs, provide investors with the ability to profit from declining markets by delivering returns that are inversely correlated to the performance of underlying indices or sectors. QQQY may employ inverse ETFs as a hedging tool to mitigate downside risk and protect investor capital during bearish market environments. By allocating a portion of the portfolio to inverse ETFs, QQQY can offset losses from declining markets and potentially generate positive returns, thereby enhancing overall portfolio resilience and risk-adjusted returns. 4. Dynamic asset allocation. QQQY employs dynamic asset allocation strategies to adjust its portfolio composition in response to changing market conditions and risk profiles. During periods of heightened volatility or uncertainty, the ETF may shift its allocation towards defensive assets, such as cash, bonds, or defensive sectors, to reduce downside risk and preserve capital. Conversely, in periods of market stability or optimism, QQQY may increase its exposure to growth-oriented assets, such as equities, to capitalize on potential opportunities for capital appreciation. By dynamically allocating assets, QQQY aims to optimize risk-adjusted returns and adapt to evolving market dynamics effectively. In conclusion, the QQQY ETF employs a range of hedging strategies to mitigate downside risk in volatile market conditions, including option strategies, derivatives, inverse ETFs, and dynamic asset allocation. Through these protective measures, QQQY aims to preserve investor capital, enhance risk-adjusted returns, and navigate turbulent market environments effectively. By understanding QQQY's approach to risk management and hedging, investors can gain confidence in the ETF's ability to safeguard their investments while pursuing long-term financial goals. Question 7. How has the QQQY ETF performed compared to its benchmark and other similar ETFs over different timeframes? As investors seek to achieve their financial goals, assessing the performance of ETFs becomes paramount in making informed investment decisions. The QQQY ETF, renowned for its equal-weighted exposure to the Nasdaq 100 index, offers investors the opportunity to participate in the growth potential of leading technology and innovation companies. However, evaluating its performance relative to its benchmark and peers provides valuable insights into its competitive positioning and ability to generate returns across different market conditions. Relative performance versus benchmark. QQQY ETF versus Nasdaq 100 index. One of the primary benchmarks for the QQQY ETF is the Nasdaq 100 index, which comprises the 100 largest non-financial companies listed on the Nasdaq stock market. Analyzing the performance of QQQY relative to its benchmark over various timeframes, such as 1 year, 3 years, and 5 years, allows investors to assess its ability to replicate the index's returns while accounting for fees, tracking error, and other factors. Comparative analysis with similar ETFs. QQQY ETF versus similar technology and growth ETFs. In addition to comparing QQQY's performance against its benchmark, investors may also evaluate its performance relative to other ETFs with similar investment objectives and strategies. This includes ETFs focused on technology, growth, or equal-weighted exposure to specific indices. By conducting a comparative analysis, investors can identify potential outperformers, assess relative risk levels, and determine the most suitable investment option for their portfolios. Performance metrics. 1. Total returns. Total returns reflect the cumulative performance of the QQQY ETF, including capital appreciation and dividends reinvested over a specific timeframe. Analyzing total returns provides investors with a comprehensive view of the ETF's performance relative to its benchmark and peers, taking into account both price appreciation and income generation. 2. Risk-adjusted metrics. Risk-adjusted metrics, such as Sharpe ratio, Trainer ratio, and Sortino ratio, assess the risk-adjusted returns of the QQQY ETF relative to its benchmark and peers. These metrics account for the level of risk undertaken by the ETF to generate returns, offering insights into its efficiency in delivering risk-adjusted performance. 3. Volatility and drawdowns. Volatility measures the degree of fluctuation in the QQQY ETF's returns, while drawdowns reflect the peak-to-trough decline in its value during specific periods. Analyzing volatility and drawdowns helps investors evaluate the level of risk associated with the ETF and its resilience during market downturns. In conclusion, assessing the performance of the QQQY ETF relative to its benchmark and peers provides investors with valuable insights into its competitive positioning and ability to generate returns across different timeframes. By analyzing total returns, risk-adjusted metrics, volatility, and drawdowns, investors can gain a comprehensive understanding of QQQY's performance and make informed investment decisions. Question 8. What criteria are used to identify potential growth opportunities within the ETF's investment universe? In today's dynamic market environment, identifying potential growth opportunities is essential for ETFs seeking to deliver sustainable returns to investors. The QQQY ETF, renowned for its equal-weighted exposure to the Nasdaq 100 index, is well-positioned to capitalize on growth opportunities within the technology and innovation sectors. Understanding the criteria used by QQQY and similar ETFs to identify growth prospects provides valuable insights into their investment strategies and potential for long-term success. Criteria for identifying growth opportunities. 1. Revenue growth potential. ETFs like QQQY assess the revenue growth potential of companies within their investment universe to identify growth opportunities. This includes evaluating historical revenue growth rates, revenue forecasts, and revenue drivers, such as product innovation, market expansion, and customer acquisition. Companies demonstrating strong revenue growth potential are often viewed favorably by ETFs seeking to capture growth opportunities in their portfolios. 2. Earnings potential. In addition to revenue growth, ETFs consider the earnings potential of companies as a key criterion for identifying growth opportunities. This involves analyzing earnings growth rates, profit margins, earnings forecasts, and profitability metrics to assess the sustainability and quality of earnings. Companies with strong earnings potential are better positioned to generate sustainable growth and create long-term value for shareholders, making them attractive investment candidates for ETFs like QQQY. 3. Market positioning. ETFs evaluate the market positioning of companies within their investment universe to identify growth opportunities. This includes assessing market share, competitive landscape, barriers to entry, and industry dynamics to determine companies' ability to capitalize on market opportunities and gain a competitive edge. Companies with strong market positioning and competitive advantages are better positioned to sustain growth and outperform peers over the long term, making them attractive investments for growth-oriented ETFs. 4. Competitive advantages. ETFs seek to invest in companies with sustainable competitive advantages, such as proprietary technology, intellectual property, brand recognition, and economies of scale. These competitive advantages enable companies to differentiate themselves from competitors, protect market share, and sustain growth over the long term. ETFs like QQQY prioritize companies with strong competitive advantages, as they are better positioned to withstand competitive pressures and capitalize on growth opportunities in their respective industries. 5. Technological innovation. ETFs focus on companies at the forefront of technological innovation to identify growth opportunities within their investment universe. This includes investing in companies driving innovation across sectors such as technology, healthcare, consumer discretionary, and industrials. Companies leveraging disruptive technologies, such as artificial intelligence, cloud computing, biotechnology, and renewable energy, are well positioned to capitalize on growth opportunities and create long-term value for shareholders. In conclusion, identifying potential growth opportunities within the ETF universe involves assessing factors such as revenue growth potential, earnings potential, market positioning, competitive advantages, and technological innovation. ETFs like QQQY utilize these criteria to identify companies with strong growth prospects and allocate capital to capture growth opportunities within their portfolios. By understanding the criteria used to identify growth opportunities, investors can gain insights into ETFs' investment strategies and potential for generating long-term returns. Question 9. What are the key considerations for investors when evaluating QQQY as part of a diversified portfolio? As investors seek to achieve their financial objectives, diversification emerges as a cornerstone of prudent investment management. The QQQY ETF, known for its equal-weighted exposure to the Nasdaq 100 index, offers investors access to a diversified portfolio of high-growth companies. However, evaluating QQQY's suitability within a diversified portfolio requires careful consideration of various factors to ensure alignment with investors' objectives and risk preferences. Key considerations for investors. 1. Investment objectives. The first consideration for investors when evaluating QQQY is to assess whether the ETF aligns with their investment objectives. QQQY aims to provide exposure to high-growth companies listed on the Nasdaq 100 index, making it suitable for investors seeking capital appreciation and exposure to innovative sectors such as technology, healthcare, and consumer discretionary. Investors should evaluate whether QQQY's investment objectives align with their long-term financial goals and risk tolerance. 2. Risk profile. Understanding the risk profile of QQQY is essential for investors assessing its suitability within a diversified portfolio. While QQQY offers exposure to high-growth sectors, it may also exhibit higher volatility compared to more diversified or conservative investments. Investors should evaluate their risk tolerance and investment horizon to determine whether QQQY's risk profile aligns with their risk preferences and investment objectives. 3. Correlation with other holdings. Investors should consider the correlation between QQQY and other holdings within their portfolio when evaluating its role in diversification. While QQQY offers exposure to growth-oriented sectors, it may exhibit high correlation with other equity holdings, particularly those focused on technology and innovation. Investors should assess whether QQQY provides diversification benefits by introducing uncorrelated or negatively correlated assets into their portfolio. 4. Sector exposure. Evaluating QQQY sector exposure is critical for investors seeking to maintain a balanced and diversified portfolio. While QQQY is heavily weighted towards technology and communication services sectors, it also provides exposure to healthcare, consumer discretionary, and industrial sectors. Investors should assess whether QQQY's sector exposure complements their existing holdings and helps achieve diversification across different sectors and industries. 5. Performance history. Analyzing QQQY's performance history provides insights into its risk-return profile and potential for generating returns over time. Investors should evaluate QQQY's historical returns, volatility, drawdowns, and performance relative to its benchmark and peers. While past performance is not indicative of future results, assessing QQQY's track record can help investors gauge its ability to deliver on its investment objectives and generate returns in various market environments. 6. Fees and expenses. Assessing QQQY's fees and expenses is essential for investors evaluating its cost-effectiveness within their investment portfolio. While ETFs typically have lower expense ratios compared to actively managed funds, investors should consider QQQY's expense ratio and any additional costs, such as trading commissions or bid-ask spreads. Evaluating QQQY's fees in conjunction with its performance and diversification benefits can help investors determine its overall cost-effectiveness within their investment strategy. In conclusion, evaluating the QQQY ETF as part of a diversified portfolio requires careful consideration of various factors, including investment objectives, risk profile, correlation with other holdings, sector exposure, performance history, and fees. By assessing these key considerations, investors can make informed decisions about incorporating QQQY into their investment strategies and achieving their long-term financial goals. Question 10. What are the long-term growth prospects for QQQY, and how does the ETF aim to capture opportunities in evolving market landscapes? As investors navigate dynamic market environments, the quest for long-term growth remains paramount. The QQQY ETF, renowned for its equal-weighted exposure to the Nasdaq 100 index, is well-positioned to capitalize on evolving market landscapes and technological innovations. Understanding the long-term growth prospects of QQQY and its strategies for capturing opportunities is essential for investors seeking to achieve sustainable returns and build wealth over time. Long-term growth prospects. 1. Technological innovation. The cornerstone of QQQY's long-term growth prospects lies in its exposure to companies at the forefront of technological innovation. The Nasdaq 100 index comprises leading technology, healthcare, and consumer discretionary companies driving innovation and disruption across industries. As technological advancements continue to reshape global economies, companies within QQQY's portfolio are well-positioned to capitalize on emerging trends, such as artificial intelligence, cloud computing, e-commerce, and biotechnology. 2. Sectoral trends. QQQY's sectoral diversification allows it to capture growth opportunities across various sectors and industries. While technology and communication services sectors dominate the index, QQQY also provides exposure to healthcare, consumer discretionary, and industrial sectors. Sectoral trends, such as the proliferation of digital health solutions, the rise of e-commerce, and the adoption of renewable energy technologies, present significant growth opportunities for companies within QQQY's portfolio. 3. Market dynamics. QQQY's long-term growth prospects are influenced by evolving market dynamics, including changing consumer preferences, regulatory trends, and global economic conditions. As markets adapt to new realities, companies within QQQY's portfolio must innovate, adapt, and seize opportunities to drive growth and maintain competitive advantage. By staying attuned to market dynamics and emerging trends, QQQY aims to position its portfolio to capitalize on evolving opportunities and deliver sustainable growth over the long term. Strategies for capturing opportunities. 1. Active selection of growth stocks. QQQY employs an active selection process to identify and invest in companies with strong growth potential within its investment universe. This involves conducting fundamental analysis, evaluating revenue growth, earnings potential, market positioning, competitive advantages, and technological innovation to identify companies poised for long-term growth. By actively selecting growth stocks, QQQY aims to build a portfolio of high-quality companies with the potential to outperform over the long term. 2. Equal-weighted exposure. QQQY's equal-weighted exposure to the Nasdaq 100 index enables it to capture opportunities across a diverse set of companies while mitigating concentration risk. Unlike traditional market cap-weighted ETFs, which allocate higher weights to larger companies, QQQY assigns equal weights to all constituent stocks, ensuring broad-based exposure and enhancing diversification. This approach allows QQQY to capitalize on opportunities among both large and small-cap companies within the index. 3. Dynamic rebalancing. QQQY employs dynamic rebalancing to adjust its portfolio composition in response to changing market conditions and investment opportunities. This involves periodically rebalancing the portfolio to maintain its equal-weighted exposure to the Nasdaq 100 index and capture evolving growth prospects. During rebalancing, QQQY may trim positions in overvalued securities and increase exposure to undervalued or outperforming companies, optimizing the portfolio for long-term growth. 4. Sector rotation strategies. QQQY may implement sector rotation strategies to capitalize on sectoral trends and opportunities within its investment universe. This involves shifting capital across sectors based on relative strength, valuation metrics, and macroeconomic factors. By dynamically rotating sectors, QQQY aims to position its portfolio to capture growth opportunities while managing risk and enhancing diversification. In conclusion, the QQQY ETF offers compelling long-term growth prospects by providing exposure to companies at the forefront of technological innovation and sectoral trends. Through active selection of growth stocks, equal-weighted exposure, dynamic rebalancing, and sector rotation strategies, QQQY aims to capitalize on evolving market landscapes and deliver sustainable growth to investors. By understanding QQQY's strategies for capturing opportunities and its potential for long-term growth, investors can make informed decisions about incorporating the ETF into their investment portfolios. QQQY ETF stands poised to navigate growth opportunities in evolving market landscapes, driven by its active selection of growth stocks, equal-weighted exposure, dynamic rebalancing, and sector rotation strategies. As investors chart their course towards long-term success, QQQY remains a compelling option, offering access to high-growth sectors and innovative companies. By understanding QQQY's strategies and potential for growth, investors can embark on a journey towards financial prosperity with confidence and conviction.